Welcome to Kalkine. Today, we're diving into the world of derivatives, those tricky financial things that can be hard to figure out. So, what exactly are derivatives? Derivatives are financial instruments whose value is derived from the value of an underlying asset, index, or rate. They are contracts between two parties, known as the buyer and the seller, where the value of the derivative is determined based on the fluctuations in the value of the underlying asset. Here's a breakdown of some key aspects of derivatives. 1. Definition. Derivatives are financial contracts that derive their value from the performance of an underlying asset, index, or rate. The underlying assets can include stocks, bonds, commodities, currencies, interest rates, and market indexes. 2. Benefits. Risk management. Derivatives provide a way for investors to manage risk by hedging against adverse price movements in the underlying assets. Speculation. Investors can also use derivatives to speculate on the future price movements of underlying assets, potentially earning profits if their predictions are correct. Liquidity. Derivatives markets often offer high liquidity, allowing investors to enter and exit positions relatively easily. Price discovery. Derivatives markets can contribute to price discovery by reflecting market sentiment and expectations about the future performance of underlying assets. 3. Types. Futures contracts. Futures contracts obligate the buyer to purchase and the seller to sell an underlying asset at a predetermined price and date in the future. They are standardized contracts traded on exchanges. Options contracts. Options give the buyer the right, but not the obligation, to buy, call option, or sell, put option, an underlying asset at a predetermined price, strike price, within a specified period. Forward contracts. Similar to futures contracts, forward contracts involve agreements between two parties to buy or sell an asset at a future date and price, but they are customized and traded over the counter, OTC. Swaps. Swaps are agreements between two parties to exchange cash flows or other financial instruments based on predetermined conditions. Common types of swaps include interest rate swaps, currency swaps, and commodity swaps. We hope you find this video informative. For more related content, please consider liking the video and subscribing to our channel.